lines, but let's quickly chat with Vaidyanathan, who now joins us in the studio from Capital First. He's the CMD there. Very happy that you could join us, Mr. Vaidyanathan. First up, quickly let's chat about the surprise news that came in about the rate cuts. First up, what is the kind of rate cuts would you see over 2015 and the time, and how soon do you think the banks could cut rates too?
First of all, if you notice what the RBI said last time, saying that you don't have to wait for the policy news for the rate cut to happen, probably that was a clue to let you know that it could happen any time. As far as banks are concerned, mainly banks today are competing against mutual funds because the real interest rates in the economy in the form of NCDs, bonds, CPs are already below the base rate. So therefore, banks have to compete. If banks could lend, I'm sure they'd lend to AAA companies at even below base rate. So I think it's a matter of time. I think they're waiting to kick it off. Maybe it's a matter of maybe 3 months or 2 months, but not beyond that for sure.
But did this, Mr. Vaidyanathan, come as a bit of a surprise, or had you sort of penciled in?
See, the markets had already penciled it in. To give you an idea, base rates are at 10.25 for most public sector banks and maybe 10% for some. But in the bond market, it's already quoting at about 9%, 9.25% for a 3-year paper for a AA plus AAA company. So net companies are borrowing at rates lower than base rate. So markets already have factored that in. So it's not that much of a surprise in my opinion. And therefore, I think that it's only a matter of time. The banking system aligns itself to the rest of the markets.
Okay. And Mr. Vaidyanathan, what do you think could be the longer term impact of these rate cuts?
See, one very significant thing is that the RBI thought long and hard about this rate cut. And they did not move to it at the first sign of inflation coming down. They watched it over a period of time. And the fact that they deliberated so much about this means that in many ways, barring unforeseen circumstances, this is going to be a one-way track down, maybe about 100 basis points in a year or so. The longer term impact is actually much more significant because what's happening is the stock market's coming up, building up the way they are. It is going to be easier for, so to say, stressed companies to raise equity, and couple that up with the lower interest rates. It's a recipe for many difficult accounts to come out of trouble. So therefore, I think the longer term impact is much more significant. It's just not the impact of the 25 basis points of today.
And clear indications coming in from the banks as we speak. In fact, that's a flash coming in on your screen. United Bank is the first one to go ahead and cut their base rate, and it's a quantum of 25 basis points to 10%, and this will be effective 1st of February. The stock clearly has been fairly upbeat, but in fact, reacting further to that news, it's 3.5% notch up on United Bank. But Mr. Vaidyanathan, I want to talk a little bit more about the long-term implications, particularly when it comes to credit growth. How much of an impact do you see that having on the back of this news?
See, when the rates come down by 25 basis points or 50 basis points, the first impact is on the consumer. If you look at the corporate still has to get its approvals from the local governments, central governments. Projects have to move for them to for them to draw the money and install capacity. So credit growth on the corporate side could still take maybe 6 to 12 months, but consumer will react here and now because he has no projects to bother about. So if he's looking for a home loan, he was on the fence, he'll probably go ahead and buy it. Want to take a car loan, he'll probably go ahead and do it. So consumer will react first, corporate will react later. But I think in the next 1 year, you'll see credit growth coming back to about 15%, which was down about 12%, 13% for the last 2 years.
Okay, let's also talk about borrowing costs then. How do you think that could get impacted? Also, yields and margins, would you expect an impact on that as well?
Yes, borrowing costs will certainly come down. They're already coming down for the reasons I told you on the parallel market of the banking, which is mutual funds. And I think that about a 25 basis points reduction in borrowing cost should be priced in the next maybe 3 months or so. You already just now read that United Bank has cut the base rate. I'm telling you, they're competing with mutual funds.
Well, Mr. Vaidyanathan, as of now, let's talk specifically, about the company. The AUM stands at about 11,045 crores, profit at 27 crores for the second quarter. What level can we expect in terms of numbers for the loan book and profit growth over the next 1 to 2 years, and what will be the drivers?
Okay, right. We are 11,000 crores. A 25 to a 30% growth, probably 30% growth in this financial year, and a 25 to 30% growth over the next 2 or 3 years can be safely penciled in for Capital First. Because we are in a space which is small and medium enterprises financing, which is in a way a blue ocean. There's a huge market out there, and we think we have the necessary technologies to keep growing that business and so on. So that's one piece. The second part, you talked about profits. We think that for us we had earlier guided that we'll probably post about 100 crores of profit. It looks to us that we'll probably post a little higher than that. And I think the profits will outpace the growth of the book because the operating leverages are getting better.
Okay, so do you see loan growth to improve in these segments post the rate cuts?
Well, that's a good question. The loan growth, our guidance always has been in the 25 to 30% range. But what will happen is the direct impact of this reduction rate will eventually pass through to these small entrepreneurs. Because we are already seeing that factory output is beginning to show up. There are more orders in the auto sector. Auto sales have come out on the positive side very recently. Two-wheelers are coming in the positive zone again, 10-12%. So therefore, the impact on producers at a micro level is already beginning to come. So moment small entrepreneurs start producing more, they will need more demand for funds. So it's a chain reaction. So really, there is no dearth of credit demand at the small entrepreneurs level, not at all.
And what's the impact on asset quality? Where do you see the gross NPAs from the current 0.56% as of the second quarter? And what is the provision cover that you will maintain?
See, we are currently running over 99% provision cover, and gross is, as you said, 0.56%. I really don't see any challenge on the asset quality front. Not just for us. I think overall, as a system, also barring the large few corporate accounts which went down in the economic cycle, maybe the airlines and the oil and so on. On the small entrepreneur side, on the consumer financing side, on the auto loan side, on the home loan side, which is normally the consumer story. Not just us. I think the whole system is holding up really quite well. In fact, if there's one oasis of good quality in India, certainly it's still the retail customer.
Okay, and you've recently got housing finance company license from NHB. Where do you see the housing finance book over a period of time?
Yes, our housing finance book is already reached, I'm happy to share with you, 150 crores of loan book. And we think that this business has, as you know, India is deeply underpenetrated in housing. So this can grow about, again, a 30% growth over the next 4 or 5 years is something that we can safely look at, probably a little faster than that.
And many analysts see, NHB hiking the minimum tier 1 capital for housing finance companies at 10%. Is that something that you're penciling in as well? And if so, what would be the impact for your capital needs?
See, if you see the new norms for even from RBI, not just NHB that have come about, I think the new norms are already out. It's 10% for tier 1 and it's 15% for tier 1 plus tier 2. We are running a combined capital adequacy of 21%. So, I think that we've always kept ourselves a substantial cushion over the minimum requirement. So, I cannot say it has, I would say therefore it has no real impact on us.
Now, Warburg Pincus sold nearly 71.9% and has invested close to 128 crore rupees via its affiliate Cloverdale Investment in FY14. Is there any possibility of a further hike in stake by Warburg Pincus, and how long will current capital last?
See, Warburg Pincus holding say 72% of the equity lends tremendous strength to the company, and they have reiterated the commitment by infusing fresh equity last year, in March of last year. So really, if there was a need for capital, certainly there are many options for raising it now. There could be a QIP, there could be a preference and so on. And we already have a board resolution for raising rupees 300 crores of equity. But the current equity itself will hold us for a while. As I said, our current adequacy is 21%. So it can hold us for a while now.
And, just let's talk about the overall macroeconomic scenario, and what are you penciling in terms of inflation forecasts for FY16 in response to particularly the way we've seen the oil price dynamics and, the kind of commentary that the RBI governor has been reiterating?
See, the RBI governor's commentary is very important in the context of what they said at the time of this rate cut. They said a lot will depend on the quality of fiscal deficit, that will be maintained. So in that context, the budget becomes really very important, whether the reduction from 4.1% down to the 3.6% and the fiscal roadmap is maintained. If that is maintained, it will give the RBI a substantial headroom for further reduction. So I think the budget is going to be a key item. The other thing is about oil. I think oil was certainly the surprise element of the last 6 months, I think, in many ways. And I think it gave the government a substantial headroom. So the fiscal deficit at 4.1% was sounding a challenge until in the beginning of the year. It doesn't look like a challenge that more, because it's 50 billion of savings. It's big savings.
Okay, we'll leave it at that, Mr. Vaidyanathan. Lovely to have you with us on the show and giving us all of your views on what the impact is from the surprise rate cut on the macroeconomic situation as well as for the company in specific.
Thank you.
Okay, but let's move on away from all of that big news. That's a stock, by the way, of Capital First, holding out in the green, the Nifty at 8404 as we speak. But in fact, we've got the management of Vibrant Digital joining in.